Are you curious about how many dollars you're paying for just $1 of earnings? Let's dive into the world of PE ratios and discover when a high PE actually means buy low. Stick around until the end for a simple PE playbook you can start using tomorrow. Investing doesn't have to be complicated. Let's break it down together.
So when we start looking at ways to measure stocks, now I am not a huge fan of price to equity, which is the PE ratio, because as somebody who is just like listeners here, and as Gary knows, we've been through a lot of boom and busts, and PEs can get really high and they can get really low. And one of the running jokes when a company is not doing well, cheap can get cheaper until it's bankrupt. And just like Nvidia and the Magnificent Seven, expensive can get expensive to get ludicrous. And so you almost have this FOMO or fear of missing out where you have these ratios that can explode to the upside. And it's a good metric because you have to base it on something, but it should always be paired with other things. And I'd be interested to know, how do you think of PE value? How do you kind of factor that into your evaluation of a company and a stock?
So I think this is a really important topic, Mark, because it's one of the most basic ones. The PE, the price to earnings ratio, it's one of the most widely used metrics in investing. And I'm going to tell you about a conversation. I had lunch with a friend of mine a number of years back, and he invests, and he had, a decent sized account. He had a seven-figure account, and he's investing all the time based on what they say on CNBC. And he said to me, "Hey, can I ask you an investing question?" I'm like, "Sure, yeah, what's on your mind?" He said, "What's this PE ratio they keep talking about on CNBC?" And I realized, oh my God, this guy's trading, millions of dollars of stock on a daily basis, but doesn't know what this is. And it's really important sometimes to just go to the basics for people. So let's unravel it for people and just help them understand. So PE stands for price to earnings ratio. The price is the price per share. The earnings is the earnings per share. So if you take the net income of the company divided by the number of shares, that gets you your earnings per share, your EPS. If you have a stock that's trading at 20 and the company earned $2 of earnings, their EPS is $2, then it's trading at a 10x PE ratio, which is just a fancy way of saying that you're paying $10 for every dollar of earnings that you're getting from the company. Now, the reason a PE ratio is a useful indicator in the realm of market expectations and sentiment is because it does tell you what the market expects for these companies. In general, a high PE ratio will be assigned to a high quality company and one where you're getting a lot of earnings growth. In general, the bargains, as you pointed out, cheap can get cheaper and cheaper and cheaper all the way down to zero. And
Yep.
you don't get a big PE multiple on companies where earnings aren't growing, the opposite of Nvidia, right? Where the earnings are shrinking. And so these are things that you look at, and it does give you a sense of how the market is valuing different companies. Now, I think one really good way to use the PE ratio is compare it to the company's growth. Another good way to do it is compare it to other comparable companies. And so if you see a situation where, one company in industry has a very high PE ratio, but the other companies in the industry have much lower ones, there is a reason that there's an outlier. Now, that reason could be wrong, but it does say to you, you need to go find out what this is. And, we saw this. This was a number of years ago. I invested in some of the health insurance companies. I'm not involved in them right now. But, a situation where that we looked at, one of these companies was trading at a much lower PE ratio than the others. Now, in this case, the reason for the discount was wrong, but you needed to understand the reason to know why you were investing in the stock. And that was the thing that mattered. People were looking at this wrong. And that's what created the opportunity. The one other thing that I'll tell you is there are situations where the PE ratio does lie to you. So in the case of cyclical companies, you typically want to buy the stock when earnings have bottomed and sell the stock when earnings have hit their cyclical high. But just remember that when earnings have bottomed, you have a very high PE ratio. And when earnings are high, you have a low PE ratio, and that's the signal to sell. So again, it really depends on the business, it depends on the industry. The last point I'll make on this is, and this will be hard for amateur investors to do, but it is worthwhile to go through the income statement with a fine-tooth comb and do your own version of adjusted earnings. Now, companies will give you adjusted earnings, and I promise you the adjusted earnings are almost always higher than the GAAP earnings, right?
Mhm.
The adjustments only go one way. It's kind of like
Yep.
the government giving you the CPI, the Consumer Price Index. They never adjust it down. They never adjust it up. They only adjust it down. They like to make inflation look lower than it
Yep.
seems, right? But there are all kinds of things that companies can do to screw around with their earnings per share. And that's a very long, complicated, accounting heavy question that is it's far too much to talk about in an educational segment here. But there are all kinds of ways that companies can play around with it. And so if a company artificially increases their earnings, but it's not sustainable, it's going to look like the PE ratio is lower than it really should be. And it'll look like you're buying the company at a discount when you're not. So it is worthwhile, and it can be tough, like I said, for amateur investors. But go through the income statement, see if everything sort of passes that sense of smell test, and see if there are things that maybe you want to adjust. It's also worthwhile to take a look at the cash flow statement. If the whole thing is daunting, then just look at the first part of the cash flow statement, cash from operations. Sometimes you see things there that you might want to use to adjust your earnings to get a more accurate PE ratio. But those are my thoughts on it. How are you using it? Or maybe you don't.
So I'm similar to yourself, and I think you bring up a great point of looking at it from the perspective of industry specific. You can't compare an Nvidia to a GE, just like you can't compare a GE to a JP Morgan. You have to look at the industry that it's in other cyclicals or under high or equal high growth stocks, because otherwise you're going to be comparing apples to oranges, and you really want to keep things specific. For me, obviously it's an important metric, but not an end all and be all, to your point on cash flow. I care more about what is my free cash flow, how much money is the company generating, because I think one of the key components, and as I don't want to get too far into it because, as you said, it's a complicated topic, but one of the key pieces, especially because we talked about Nvidia and the buybacks can be used to really skew this. And it's really, you're leveraging the balance sheet where you're borrowing against it, and then you're buying back stock to really kind of manage that. And we go into to your point, the balance sheets, the cash flow statements, the income statements, to really look at, okay, what is my cash flow? What is my cash flow after interest expense? So essentially, do you have a great price to earnings ratio because you're buying back stock, but you're doing it with borrowed money, and the company's actually losing cash? And I think that is the big piece of what is the use of capital. And a company that is really good at the use of capital is going to be reinvesting in R&D, investing in that distribution, investing in growth, because personally, and this is always a back and forth, I'd rather get paid for owning your stock. I want dividends. I want to know that you're rewarding me for this growth. I don't want you to reward someone selling the stock where it may make my portfolio look really good because it's going to artificially keep that stock higher, but just pay me for owning it in that income stream. And I think it's going to be an interesting setup when you start seeing the boomer generation retiring, looking for those income streams on how do companies address, because in the past it was buy back stock, increase price per share, and that's great. But now, are we going to want more income generation? Back to kind of where we were in those 50s, 60s, 70s, until we started to get into the 80s and 90s, where price per share mattered way more. And I think that's going to be an interesting pivot over the next decade as people start to retire and look for that fixed income stream.
All right. Well, that's a great point. The only thing I'd add to that is that stock buyback does result in income. You just have to sell some stock to do it, but at least then you have
Exactly.
control of your tax situation. But
Yep.
at any rate, that was an educational topic from a couple of months ago. We actually did the dividends versus buybacks capital allocation one for people.